Aeon is one of the major players in Malaysia retail industry and was established in 1984 as part of the Japan-based Aeon Groups. The company was invited by the Malaysia government to help revitalize the country retail sector. Starting with the first outlet at Plaza Daya Bumi, Kuala Lumpur, Aeon has expanded rapidly and now owns numerous Aeon malls and department stores across Peninsular Malaysia. The company vision is guided by the customer first philosophy, which emphasizes peace, people, and the community. In terms of its nature of business, Aeon operates in retail and property management. Its retail operation include supermarket, department store, and pharmacy, such as Aeon Wellness, offering a wide range of products including groceries, apparel, household items, and electronics. In addition, Aeon manages shopping malls and has expanded into online platform to adapt to modern lifestyle shopping trends.
Next, 7-Eleven Malaysia Holdings Berhad is the largest convenience store chain operator in Malaysia, incorporated in 1984 under a franchise agreement with 7-Eleven in the United States. Its first store was opened at Jalan Bukit Bintang, Kuala Lumpur, and today the company operates more than 2,000 and 1,400 outlets nationwide. Its motto, "Always There For You," reflects its strong presence and accessibility across all segments of Malaysian society. Regarding its nature of business, 7-Eleven operates as a 24 hours convenience retailer, providing quick and easy access to daily necessities. Its product offering include ready-to-eat food, iconic beverage such as Slurpee and light groceries item. Beyond product sales, 7-Eleven also serves as a service provider, offering bill payment service, touch and go card reload, SIM card sales, and parcel delivery service, with a strong business focus on 7E-Cafe concept.
So next, we move on to liquidity ratio. So first thing first that we have in liquidity ratio is current ratio. So basically the current ratio is compares a firm's current or liquid asset to its current short-term liabilities. So the formula for current ratio is current assets divided by current liabilities. And the next one is quick ratio. Quick ratio excludes the inventory from current assets, as inventory may always be very liquid. And the formula for quick ratio is current assets minus inventory divided by current liabilities. So the next one is average collection period. So in average collection period, it measures the numbers of days it takes the firms to collect its receivables. So the formula for average collection period is equals to account receivable divided by annual credit sales, and we have to divide by 365 days to get the days of average collection period. And next one is account receivable turnover. Basically, account receivable turnover is measure how many times account receivables are rolled over during a year. So the formula for account receivable turnover is equals by annual credit sales divided by account receivable. So the last one for liquidity ratio, we have inventory turnover. So basically, in inventory turnover, it measures how many times the company turns over its inventory during the year. Shorter inventory cycles lead to greater liquidity since the items in inventory are converted to cash more quickly. So the formula for inventory turnover is COGS, which is cost of goods sold divided by average inventory. Next one, we have capital structure ratio. So first thing first that we have in capital structure ratio is debt ratio. Debt ratio measures the proportion of the firm's assets that are financed by borrowing or debt financing. So the formula for debt ratio is liability divided by assets. Next is time interest earned. Time interest earned measures the ability of the firm to service its debt or repay the interest on debt. So the formula for time interest earned is EBIT, or operating income, divided by interest expense.
Total asset turnover. Total asset turnover ratio represents the amount of a sale guarantee per dollar inventory in firm asset. Total asset turnover sale dividend total asset. Fixed asset turnover. Fixed asset turnover sale dividend net plant and equipment. Fixed asset turnover ratio measure firm efficiency in utilizing in fixed assets such as property, plant and equipment. Gross profit margin. Gross profit margin show how will the firm management control its expense to generate profit. How to manage gross profit margin? Gross profit divide sale. Operating profit margin. Operating profit margin makes sure how much profit it generates from each dollar on sale after accounting for both cost of goods sold and operating expense. Operating profit margin the OPT and OPM net operating income or EBIT divide sale. Net profit margin. Net profit margin makes sure how much income is generated from each dollar of sale after adjusting for all aspects including income tax. Net profit margin. Net income divide sale. Operating return asset. Operating return on asset OROA. Net operating income or EBIT divide total asset. Operating return on asset ratio is the summary measure of operating profitability which take into account both the management such in controlling expense contributing to profit margin and its efficient as on asset to generate sale. Return on equity. Return on equity ratio make sure the accounting return on the common stockholder investment. Return on equity, net income divide common equity.
Assalamualaikum, my name is Hassa and my number metric is 824837898. I will present the horizontal analysis and the financial performance comparison between 7-Eleven Malaysia and Aeon Malaysia from 2022 to 2024. Starting with liquidity, both companies record current and quick ratios below 1 for most of the period, indicating weak short-term liquidity. However, Aeon showed gradual improvement and reached its strongest liquidity position in 2024. In contrast, 7-Eleven liquidity position remained unstable, although it's improved temporarily in 2023. Moving on to efficiency, 7-Eleven performed very well in receivable collection and asset utilization. This is reflected in its high account receivable turnover and increase in total asset turnover, which shows that the company was efficient in generating sales from its asset. However, its inventory turnover declined over time, indicating slower movement of stock. Aeon also showed improvement in receivable collection, especially in 2024, when the average collection period reduced to only 5 days. Similar to 7-Eleven, Aeon experienced a downward trend in inventory turnover. In terms of leverage, 7-Eleven had a very high debt ratio exceeding 85% through the period. This indicates a heavy reliance on debt financing and increases financial risk. Its interest coverage ratio also declined over time. On the other hand, Aeon maintained a more moderate debt ratio, although its interest coverage remained negative, showing pressure from financing costs. Looking at profitability, 7-Eleven experienced declining profit margins and return in recent years with return on equity showing high volatility. Aeon, however, demonstrated more stable and gradually improving profitability with increases in net profit margin, return on asset and return on equity. Based on overall performance, the best year for 7-Eleven Malaysia was 2023. In that year, 7-Eleven recorded its highest net profit margin at 9.70%, reflecting strong cost control and improved earnings. Return on equity also peaked at 75.60%, indicating very efficient use of shareholder equity. In addition, liquidity improved as the current ratio increased to 1.16 times, the only year above 1. Total asset turnover also rose to 1.10 times, showing better asset efficiency. Despite high debt level, 2023 represents the strongest overall performance for 7-Eleven. Performance weakened significantly in 2024. For Aeon Malaysia, the best year was 2024. During this year, Aeon achieved its highest net profit margin at 4.88%, showing consistent and stable profit growth. Return on equity increased to 10.03%, reflecting improved shareholder value. Cash collection efficiency also improved significantly, with average collection period reduced to 5 days and receivable turnover rising to 70.76 times. Although the current ratio remained below 1, it improved to 0.17, indicating a positive recovery trend. In conclusion, 7-Eleven is operationally efficient and achieved strong performance in 2023, but it carries higher financial risk due to heavy reliance on debt. Aeon, on the other hand, shows slower growth but greater financial stability, with 2024 being its strongest and most stable year. Therefore, Aeon represents a more conservative investment, while 7-Eleven offers higher risk with potentially higher returns.
My name is Naya Azmina, number registry A24B3782. For this part of the presentation, I will discuss the comparative vertical ratio analysis between Aeon and 7-Eleven for the year 2032, 2033, and 2024. The analysis focused on liquidity, efficiency, portability, and leverage performance of both companies. In 2032, 7-Eleven showed stronger liquidity compared to Aeon. Both the current ratio and liquidity ratio of 7-Eleven were higher, indicating that 7-Eleven was better able to meet the short-term obligation. Aeon, on the other hand, faced weaker short-term liquidity. In the term of efficiency, 7-Eleven outperformed Aeon. 7-Eleven had a shorter average collection period, higher receivable turnover, and faster inventory turnover. This showed that 7-Eleven managed its receivable and inventory more efficiently than Aeon in 2022. For leverage, Aeon had a lower debt ratio compared to 7-Eleven. This means Aeon relied less on debt financing, while 7-Eleven had a higher financial risk due to its high debt level. In the term of profitability, 7-Eleven recorded higher gross profit margin, operating profit margin, and return on equity. This indicates that 7-Eleven was more profitable and generated better return of shareholder in 2032. In 2023, 7-Eleven continued to maintain stronger liquidity than Aeon. Its current and quick ratio were significantly higher, indicating better short-term financing stability compared to Aeon. 7-Eleven remained more efficient in managing assets and receivables, as shown by higher asset turnover and receivable turnover. However, both companies experienced slower inventory movement compared to the previous year. 7-Eleven still recorded a higher debt ratio than Aeon, indicating higher reliance on debt financing. Aeon maintained a more conservative capital structure. In 2023, 7-Eleven significantly outperformed Aeon in terms of net profit margin and return on equity. This shows that 7-Eleven generated much higher return of shareholder despite higher financial risk. In 2024, Aeon showed improvement in liquidity as its current and quick ratio increased. However, 7-Eleven still maintained a slightly stronger liquidity position overall. 7-Eleven continued to outperform Aeon in efficiency ratios such as asset turnover and receivable turnover, indicating better use of assets to generate sales. Aeon recorded a lower debt ratio compared to 7-Eleven, showing that Aeon relied less on debt financing and faced lower financial risk in 2024. In the terms of profitability, Aeon performed better in operating and net profit margins. However, 7-Eleven still records a slightly higher return on equity, indicating better shareholder returns. In conclusion, 7-Eleven generally demonstrated stronger liquidity, efficiency, and shareholder return across the 3 years. However, this came with higher financial risk due to heavy reliance on debts. Aeon, on Aeon, on the other hand, showed weaker liquidity and efficiency but maintained a more stable capital structure and showed improvement in profitability in 2034.
My name is Nur Aryani Srina binti Ibrahim and my metric number is A2483832. Based on the financial analysis of Aeon and 7-Eleven, both companies show different financial strength but also face specific challenges that need to be addressed to ensure sustainability operation. For Aeon, the main issue identified are weak inventory management, low liquidity and high financial risk. The company inventory turnover has decreased from 2022 to 2024, indicating slow-moving stock. Moreover, Aeon should reduce low-demand product, focus on fast-moving items and use promotion or discount to clear old inventory. Inventory planning is important to avoid excess stock and losses. In addition, Aeon recorded a negative time interest earn ratio for 3 years, showing difficulty in covering interest expenses. To reduce financial risk, Aeon should control operating costs, improve operating profit, and reduce reliance on debt financing by focus more on equity financing. Aeon also needs to strengthen that liquidity position by reduce short-term liability, speeding up inventory sales, and improve debt collection to increase cash flow. Moving on to 7-Eleven, although the company show high asset efficiently, it faces challenges such as high debt level, inconsistent liquidity, and unstable profits. The company debt ratio remain very high, so 7-Eleven should limit new borrowing, focus on debt repayment, and balance its capital structure between debts and equity. Furthermore, liquidity issue and fluctuating profit indicate the need to better cost control. 7-Eleven should reduce operating expenses, maintain sufficient cash reserve, and increase sales of high-demand products such as fast food and cafe concept to stabilize profit and ensure long-term sustainability.